I mean, I
Mhm.
saw you last, what, Vancouver? I think it was VRIC,
Yep.
end of January. We were
Yep.
talking about this. I mean, you called rising yields the shark fin warning in risk
Mhm.
assets. And today, what I just said on that intro, I mean, inflation's accelerating, 30 years near five. The markets are kind of pricing a
Mhm.
possible Fed hikes instead of cuts.
Mhm.
Are
Mhm.
we seeing the system debt trap you warned about? Or is this still an energy-driven inflation scare the Fed can manage as we hear everywhere else?
I think it's energy-driven acceleration, but the destination, the direction was set long ago. And I look at I mean, everyone knows. I say it so many times. The bond market is the thing. I know it's boring. I know bond yields are boring. It's fascinating to see the 10-year at 4.46 and the DXY at 98 at the same time. And I think it's fascinating for so many reasons. I think the Fed is really losing control of the curve, and I think that's because the bond market speaks more honestly than the pundits. I'm talking about the political pundits. I think there's so much that needs to be discussed here, and any topic could take hours. But I look at what no one wants to see. That I really believe that the post-Bretton Woods world, the rule or the order has ended. There was a time post 44 when the Fed was very powerful, when the dollar was powerful, when the Fed really could, like a dial, control rates and control economies. I think that really began to disintegrate in 2020. With now the government running 7% deficits to GDP, the Fed is no longer the main actor. The debt is, the US Treasury is the main actor. And the war has certainly accelerated some of these tendencies, but the sickness was there long before this latest new headache. I think one of the best ways to see that in the bond market is, traditionally, again, in the post 44 Bretton Woods, New World Order with America, the Fed really could anchor or influence the long end of the yield curve, even though it only controls the overnight rate, the Fed funds rate. In the past, for most, certainly during my career and for the last 80 years, but really since 44, when the Fed funds rate was up, all maturities were up. And when the Fed funds rate was down, yields on all maturities were down. But if you notice this year, we've had no cuts yet by the Fed. In fact, there was a very dovish mood pre-war. And yet, as of March to April, the 10-year yield, it was fascinating. It went from under 4% to now over 4.4%. And this was done with no rate hikes or no announced rate hikes. And this is what the fancy lads on Wall Street call a bear steepener. But what it really means is the bond market is now taking control of itself, and the Fed has very few tools left. There's a risk premium that's alive and well, and it's back. Between 2015 and 2023, the premium was zero. Now, not just for the U.S. Treasury, but certainly the U.S. 10-year in particular, the world wants to see more yield for the risk. And the 10-year U.S. Treasury is no exception. It's really trading like a banana republic sovereign bond now. And it's fascinating because that is the 10-year, the sacred 10-year U.S. Treasury, the most important 10-year bond. We can talk about boons and gilts and others, but it's actually behaving outside the control of the Fed or the Fed announcements. And I think that's a dramatic sign. You can say the war accelerated this distrust of U.S. IOUs or government IOUs in general. But for the 10-year to be getting this embarrassed is fairly convincing to me that that's a watershed moment. And I'll say, in all fairness to the U.S. Treasury, the Bloomberg just came out with a chart I think it's a week ago, that really sovereign bonds in the aggregate have had the worst 5-year annualized returns in modern history, and on record for the Bloomberg index, the Bloomberg markets that's been tracking this. That's a very compelling sign. Again, it's the bond market. It's boring, but to your point earlier, those rising yields are shark fins. They represent the cost of debt. When the cost of debt gets higher in a world that literally lives and breathes off debt, whether that's at the private or the corporate or the national level, things couldn't be more telling, and I think more distressing for a system that's already, I think, radically changing. Not going to change, not in futuro, but changing right in front of our eyes. And again, I know the bond market's boring, but it's such an important indicator, and it's screaming at us that there's a pain ahead.